anybody has an age. All right, so thanks for joining. I think it was a pretty big news day and big thing. So I will just do a quick summary, and I think my intention here is to keep it pretty much interactive, trying to understand what you guys are thinking. As you may have seen, the market has definitely taken a negative reaction towards the Fed announcement. So there was no surprise on the 25 basis point, which has been the trend with Powell. I think we have never seen anything other than what market usually expects, and this time it was almost certain 25 basis point cut. I think what market is unhappy about, and which was a surprise, to be frank, is that they are now projecting only 2 cuts next year. So generally the narrative was that we may not hit the same lower rates in next 2 years, or as they call it, as a steady state rates or terminal rates. There are a lot of terms used for it, but basic idea is that where are the rates being guided for next 1 or 2 years. So I think that has been a negative. And in other words, I think we have discussed a lot of times what is like there's this whole narrative around higher for longer. And I think that is what we have started, you know, again, getting into this kind of a discussion. So I'll open it up for questions, but let me summarize. So what does it mean? In short, it means that most of the stocks which had gone up, the mid caps and small caps, since the rate cut cycle started, they are going to hurt again. I think there was a question in a press conference also that actual rates, like whether it's mortgage rates or any kind of lending rates which are like mostly 10 years to 30 years kind of rates, they are actually back to what they used to be as pretty high. And now the question is whether we are back to that higher for longer narrative. So that has spooked the market, while it does not change the basic thesis of all the mega caps, AI trade, because as we have seen, most of these cash generating companies, they have been doing well in high interest rate environment. So there's very little impact to, I would say, big tech, a lot of impact to mid cap, small cap, which are looking to borrow capital and so on. And if you think like an automotive market or housing market, definitely that is already signaling. So it's not news to them because long-term rates were already higher, and Fed is mostly reacting to that. So that's the status. I would say in short term, negative for markets, and we are seeing that correction. But I think that is mostly we are going away slightly from the Goldilocks scenario where we were saying that economy is doing good, rates are getting cut very fast. Now we are probably going to more steady state, slower rate cut cycle. So that's I think our overall thesis. So I will open it up for questions because I don't want to make it like, I want to understand how you guys are feeling and what everybody is thinking about right now based on this news cycle. Does anybody want to open up for discussion? I hope everybody can hear me.
Yes, we can hear you.
All right. So I think
what does it mean for crypto?
That's a good point. So I would say crypto is definitely going around with the market in terms of as you are seeing, the market is slightly correcting. But again, what is the theory on crypto? That stays the same, right? Means in the sense, the biggest positive which happened was because of the whole election cycle and the new administration going to boost crypto. So that doesn't change. Rates may impact the cost of capital, but that was never a concern. Like we will see whether there is a inflow changes. So I would say there is nothing fundamentally changing for crypto. Market correction will definitely play a role here. And second thing is, what would be the impact on ETF inflows?
Market में बहुत बड़ी correction आ गई stock market में. Yeah, that's it.
I'm sorry. I think, can you guys mute if you are not speaking in the calls? All right. So what we're trying to say here is that just to summarize, I mean, I think that's mostly a question for whether the inflows on ETFs, like they are not reliant on the capital, which was, either borrowed capital or means definitely it is a bad news for MicroStrategy a little bit on borrowing, because it is, if the longer term rates are higher, then the corporate debt which he's raising may not be as cheap. But on the other hand, we are also seeing that the short-term rates are going down anyway. And most of those debt players are not really seeing it as a alternative to bonds. So it's mostly a Bitcoin exposure story, which doesn't change. So in other words, short term, yes, there may be a correction, but we are not seeing anything in terms of money flow changing. And that is actually true not just for crypto, right? That's also true for AI trade. That's also true for everything where we have seen previously that there is hardly any impact of high interest rates when you are like somebody like Nvidia, somebody like Apple. Why would they have to worry about interest rates or longer term rates? Because they are actually not borrowing money. They are in fact investing, like Apple invest into treasury, and they actually make more interest on their holdings. So I would say any mega cap or crypto, which is mostly a value, like let's say growth story, let's put it that way, that is more about demand supply gap which they are covering, like AI trade, all of them will have hardly any impact in medium to long term. In short term, we might see people worrying about this higher for longer narrative, and they may go for secure safety, and there may be some small correction. And we are sitting on like 6,000 plus S&P 500 we were sitting on. So correction was due. We were kind of going up only without any meaningful correction. So this may be an opportunity where we see some small correction in stocks as well as crypto, but that doesn't change medium to long term picture in short.
Okay, thanks.
So, and again, the concern, where are the biggest changes happening right now? I think you need to look at anything which is mid cap or small cap. Like they have to worry a lot more. Like all the, like if you see IWM, which is the index tracking the Russell 2000, now that has suffered, and all the smaller cap will face questions of the optimism which we had seen since the rate cut cycle started, because the projections were we are going to be in a very, very quickly going into lower rate scenario. That is not happening. So I would say that is the part which one should worry about, where people were very optimistic, and that is changing. And another question would be like automotive market, like something like Tesla. How do they already there's even though it's in this current hype cycle, or like in general, anybody who's relying on the end user borrowing capital, as the long term rates are moving up, we believe that that can cause some demand issues. So now whether that also is a big issue, not necessarily, right? Because the long-term rates were already moving ahead of Fed. It's not that Fed has changed anything; they've just acknowledged. So previous dot plot had 4 rate cuts next year. Market was already pricing in 3 rate cuts. So market was already moving in the direction. Fed went a little more hawkish, and they are now projecting 2 rate cuts. It doesn't necessarily mean there will only be 2 cuts. So market may actually guide based on how bond markets take this forward. This will be so let me put it this way. My personal view is that this might be a knee-jerk reaction in short term, even for the long-term rates. And from here on, we might see a bottom very quickly within like a day or two, maybe by end of this week. And we may start planning now that this news is behind us. So think of it like that this was more like in a stock market terms. Let's say you were planning for a bad earning from a stock, and actually it came out bad. So usually sometimes we find a bottom immediately after that. So it's something like that which is playing out right now in the market, where they were expecting worse news from Fed than what they did last year, or well, let's say last 1 year, whenever they were projecting the rate cuts. They were projecting much faster, going down to 3.5% and 3% as terminal rate. Now they are expecting it to go slower. But Powell did not say anything that says that they are not on track to cut more rates. So this may change if bond market starts suggesting that this is the bottom. And that is what we will be observing. From here onwards, I think the biggest thing to watch out for, do US 10 years, US 20-year treasury, does that go and like the yields top out? So I hope everybody understands that when the yields are higher, the bonds prices are lower. So in other words, what I'm saying is if the longer term bonds bottom out after this news being out of the way, and why we've considered this particular FOMC meeting to be crucial is just again another thing. If you're not aware, every year we have like 8 FOMC meetings where they decide on rates, but there are only 4 meetings, like quarterly, where they update the projections, economic projections. So this is why this December meeting was way more crucial than November meeting or previous meetings, because now they have people are looking for direction from Fed on what to expect in next 2 years. And this was very critical because these are some pivots, right? Means earlier there was a big pivot around, yes, we are seeing a rate cut cycle and how fast it will go. And they actually surprised everybody when they did a 50 basis point. Now we are talking about a total shift in narrative, that even though they wanted to do it fast, and now they're acknowledging that earlier projection of rate cuts being as fast as they projected was not good enough. Like, they have to slow down. So this is usually, we call it pivot points, where markets decide how to allocate money. And this is why we were discussing this today, that this meeting was crucial, and they went more hawkish than what market was predicting. And that is the knee-jerk reaction we are seeing right now. So that is I would say, the summary, in the sense that prices usually market adjusts very fast. All the information is available to the market now.
I don't know if somebody had a question, but I was wondering, it's 4.5 is we have now almost at the 10-year. Usually that's the top, right? I mean, usually 4.5 is where it starts to taper down, usually, or the market corrects. I mean, what's the historical? There's a significance of that, right? At 4.5.
Yes. So I would say 4.5 is the area where we topped out in November. By the way, this is like not very long back, right? Means we were actually at 4.5 in November. So it's not as bad either. So let's first have that view. And second part is, when you say whether we top out, I mean, it's a good question, because we have gone higher earlier, means all the way up to 5%, which was like,
so it's only for a few weeks, if I remember right. I think it was like a couple of weeks, right?
Yeah.
We were.
But okay, let me actually see if I can open the chart here to talk about it. But yeah, I think basic idea here is that now it becomes technical. So Amit, I think what you're trying, like, we cannot just take a number and assume that 4.5 will either happen, or it will just stop there. So let me see if I have a window open. Let me share it. So this is where I think we have been sharing this chart sometimes also. So if you see, this is the breakout. Right now, to be frank, it is threatening the breakout above the November level. And it has been trending up for some time now. So question is, like, definitely the downtrend of the yields was broken way earlier. So market is aware of it. There is no surprise here. And yields have been going up. So it's not, I'm assuming everybody can see this chart which you're looking at. So we have been sharing this. And this is where I think now that we have to monitor whether we will be sticking around 4.5 and maybe we as I say, bottom out or top out on the yields. So bottoming out on the price and topping out on the yield is the same thing. So I would say this is what I'm watching very carefully right now. Even 4.7, I think, may not be as bad for the market, but if we threaten this area above, that will be pretty risky for markets. And I think let's look at what is the economic projection. Like, there are a lot of things which have been released in this FOMC. It's not necessarily just the interest rate, but also market has to take into account that there is an expectation of a better GDP, which is a positive for the market. So let's not only look into the context of interest rates. Let's look in the context of, now we are not talking about there is no recession happening. Means that thing is not yet absorbed by the market. Market is reacting to the interest rates. Market is not really yet digesting, and it will take some time for people to look at the new projection of the new GDP growth over the next few years, even with the higher interest rate projected. So this is where I think things become a little more complex. And as I said, headline news today would be that, yes, Fed is becoming hawkish and market may have a knee-jerk reaction. But if you look at a bigger picture, nobody expected us to go back to 0% rates anymore. There were a lot more concerns around recession. There were a lot more concerns around inflation. Now, if you see the inflation also, they are projecting, much better. Of course, it is in short term, the reason why they are slowing down is for the same reason, that inflation was not coming down to 2%. But now they are also increasing their range of, like, let's go back to, we might go to 2% in 2026 and 2027. And Powell said it actually in the press conference that it may take longer. And he even gave a time frame. He said it may take 2 years or 3 years. So that is the, I think, change in mindset, what people are looking at. And that will be, probably there are positives which will be taken later once people adjust to this thought of interest rates are not going to go down as fast as they were expected to.
I have a question. I see VIX has spiked up quite a bit now. It's around 26. So I'm wondering if good time to sell calls or puts or something like that.
Yes, I think that's a good point. And to be frank, this is what happens usually. If we look at some of our calls we are making in our to subscribers also, we are suggesting, in fact, we started taking positions since yesterday. We were expecting the volatility to be higher. Probably it will last for another 2 days, and it is a good time to take new positions. You're right. And I think it's also around uncertainty, right? Because markets suddenly found themselves in a surprise position where usually Powell has not surprised too much. And this time, if you see, actually there was no surprise. It was more about the dot plot. It's more about the other Fed governors who voted to a median rate of 2 cuts next year. So yes, the VIX is high. Market was caught off guard, and that usually leads to good opportunities. So I completely agree that this is the right time. If you are eyeing certain positions, we are also doing the same in the portfolio now at this moment. I think the goal here would be to find your long-term bets and sell puts or whatever position you want to enter. This might be a good time. And one thing I would like to tell everybody is that market always adjusts very fast. This discussion will continue for months, but the money adjusts within 1 or 2 days. So even if it is considered a short-term negative, whatever bottom we have to find, we might find it. We may have another day tomorrow, which may open negative, or we may not even have it. Maybe we have already seen the bottom of this quick correction. Either is possible, but what I'm trying to highlight here is that there is nothing which market did not know. And as we were looking at the long-term yields, they were already moving up. And usually the immediate reaction is much worse than what when market absorbs the other data. But again, it's too early to call. Means we have to. So to answer that question, yes, VIX is high, is a great opportunity. That also gives you an opportunity to enter safely, because if your premiums are high and if you're selling puts or something, you are basically also bringing your break-even point already at a great point, and you can roll it. But what I would like to highlight is try to play a little shorter term, like don't go more than a month around this time when the VIX is high, because you should, if let's say the market actually reverses, if the yields continue going up, you should have an opportunity to roll them. So that is one thing in keeping in mind, because valuations are pretty high. Irrespective of where, nobody can predict, even though my short-term immediate reaction to the news is that we might see this whole thing adjusting very fast within a day or two. But if we really get into a deeper correction, which is possible, in that case, you should make a plan for it. All right. Any other questions? We still have a few people coming in. I think so. Overall, I think mostly what to watch out for. Let me just say a couple of quick things. What to watch out for. What we all need to look at is as I said, long-term yields in immediate aftermath of it. Already they have spiked up, and how do they settle in next couple of days? The second thing would be how deep the mid cap and small cap correction goes, because they definitely have much bigger headwinds. And if you have portfolios which are, with the much bigger allocation into mid cap, small cap, you should look into adjusting those and at least managing the risk. As we discussed, not really worried about AI trade or crypto, because there is nothing fundamentally changing for them. Okay, I have a few questions on the chat.
Yeah.
Did
So
sorry,
Raman,
go ahead.
I asked one of the questions. So, a lot of us are more invested in tech than in non-tech stocks. So if some adjustment or correction happens, do you think it'll be more on the tech side or it'll be even across the board for large cap stocks?
Yeah, I think no, so this is a good point, but we were discussing at the start of the call that tech, the big tech, it's more about who is more impacted by higher rates. As we have seen, the tech world has navigated this whole capex boom in very well because they are cash generating machines, so they are not very much impacted by higher rates. On the other hand, the companies who are raising money or who are growth based and who don't have a great bottom line, they definitely get impacted more because they are valued at based on what is the risk free rates. So it would be less about the industry, I would say, especially in tech. I think mid cap and small cap will definitely suffer, and that is because now we are talking about what is the expected rate curve for next 2 years. And we are seeing that already. I think there are stocks which are correcting much bigger, which are of that size, who are not huge cash machines. But on the other hand, the stocks there's no fundamental change to any companies in like for example Mag 7, all the top 5, 6, 7 companies, they are generating enough cash that they in fact get better yields on their cash holdings when long-term interest rates go up or short-term interest rates go up. So for them, this is actually positive that they are generating more interest. Now, the question to ask would be whether there will be a capex change. Questions asked by their boards whether they can continue doing the capex and should they slow down if the market is going to be in this higher for longer narrative. And that we will hear probably in the next earnings cycle. But at this moment, as we focus a lot on AI trade, which is driving this whole market in last 2-3 years, we don't see that changing either because they have never bothered about interest rate. They are seeing this as such a huge opportunity that they are still on track to increase their capex by 40, 50, 60%. So, and as I said, like with GDP projections being higher, with the inflation projection getting better, probably this is a good thing. Like they are slowing down because a lot of market participants were worried that Fed is being too aggressive in rate cuts. So probably they are normalizing now that they are done with this 100 basis point in last 3 meetings. So I would say medium to long term, hardly any risk on the big tech and the tech which was already booming. The companies which were hoping for lower rates to refinance their debt, they will be the biggest one suffering because now the opportunity is slipping away. They may have to wait for much longer to get lower rates. So we should look at any company which has debt refinance coming up. Banks will be suffering, like especially their losses they are facing on the long term bonds they're holding. Similarly, any company which is debt based in any sector outside tech or in tech will be in trouble raising money. So one more thing I would like to highlight is when 2021, 2022, when the rate hike cycle started, that was well telegraphed. Everybody raised money for 3 or 4 years. That's your typical short-term money raise in corporate world. And almost everybody was, feeling relieved that we are on the rate cut cycle in 24-25. So we have talked about that a lot. Like we might see a lot more bankruptcies in next 12 months. So there will be overall headwinds because of this higher for longer narrative now. Because when your debt refinance is coming, and earlier you were okay because you were within that 3-year period where your debt is not due yet. Now you are hitting that time where the rates are not going to down anymore. In that case, there will be challenges. So let's look, and that only impacts smaller companies. So let's put it that way. All right. So I think so I don't have anything else specifically to talk about. I think just a quick summary as we discussed. So it's short-term negative for overall market. So correction, we need to figure out where we head, like how deep this correction goes. initial reaction is we should settle down within a day or two in worst case. Large cap or crypto doesn't change much. Mid cap, small cap definitely are in trouble, and I would say in general wider markets, we will have to figure out the impacts. But the biggest thing to keep in mind is that yields were already high, so most of the impact is already telegraphed to the market. Now, if they continue going higher, that will open up further risks. So we will keep talking about it in the next few days of how the bond yields react in 2 to 3 days. So other than that, if any other sector or anything you are worried about, would love to hear from others. Like, yeah, and we can take those questions. But otherwise, I think we have mostly covered what is on top of our mind. And hopefully everybody is not reacting too much on this, because as we say, right, these are any kind of a knee-jerk reaction is always a market opportunity. We did talk about that this is a great time to probably sell puts or take new positions, and this may be a good time to consider what is your medium to long-term investment plan. So that's how I would position this. I mean, nothing fundamentally has changed because market was always surprised by the fast rate cut cycle earlier.
So Raman, this is Anshu. Sorry I joined a little late. But from the last few minutes, is it correct to surmise or summarize that, Fed seems to be done with the rate cuts, or the number of rate cuts happening next year have been reduced, and so and that's kind of your interpretation?
Yeah. So let me put it this way, Anshu. So I won't say they are done, because even now market is reacting to 2 more rate cuts news, which is basically Fed is still showing that probably the long-term rates are more closer to 3% than 4%. So yes, we do have. It's about the pace of cuts. Yes,
Right.
they went very aggressive. Like if you see, like in last 3 meetings in last 3 to 4 months, they have cut by 100 basis points. So we are down 1%. So what Powell is saying is that we needed to adjust quickly because unemployment was going up, and we did it. And now we don't have to go as fast. So that is where we are. So yes, I would say they are done with the aggressive cuts, but they are not committing to any timeline, by the way. Means they might still do another 25 basis point in next 3 months, or they may not they may again pause. That will be the next thing which market will react to. Because now the market will start guiding, or like the bond yields and everything will start guiding. When are those 2 cuts? Because this was very easy, because these 4 cuts were supposed to happen within 3 months, and they stuck to it. So in that sense, yes, you are right. They're done readjusting to the level which where we are now, and we are not and when you're saying 2 cuts in a whole year, that means 25 basis point twice. 1 year is a long time. So yes, you can call that as almost being at the same level for 1 full year. But I think the other part which we were discussing earlier in the call was, this is not something which they cannot change again. Means you never know how the unemployment will go. You never know. Means we are talking about, there will be a different impact of how the economy evolves. We are talking about a new administration. We are talking about tariffs. We are talking about deportations. Like there are a lot of things which are unknown even for Fed. And that's what Powell is saying. And probably this will not be even a factor if something else changes. For example, the last cycle when we actually had the rate increases, like since 2022, AI has totally changed the thing. Otherwise, we would have been sitting at 30% correction while we are in a boom and all-time highs. Same thing for crypto. I think we have seen huge changes in what it means in near term for crypto. So I think if we are trying to understand only the rate cycle, I think, yes, they are mostly done with aggressive cuts. Now we are in a slow cycle of 25 basis point in 6 months on an average. That is the rate which is hardly going to matter in terms of rate cuts. And other factors will drive the markets, like how does the AI trade does, how the crypto policies continue changing, how the what are the individual. Probably now we are entering a stock pickers market also, because now the individual stock, now the macro direction is more or less set, that we know that we will not be going to 1% or 2% kind of interest rates. we know that we are no longer in 5% interest rate environment. So we are probably going to stick around for next couple of years in 3 to 4.25% kind of interest rate environment. So assuming such narrow range, you can imagine that now people have much more certainty of how to plan their businesses. So you will see now market and the analysts will start focusing on which business makes sense in this environment. Now there is no standard, typical headwind or tailwind, which was there in a rate cut cycle or a rate increase cycle. So very similar to what we had when we were in a pause state from 2023 to, I would say, till pretty late in 2024. So look at that period where we had seen that very clear directional trends, where we saw the AI trade play out, where we saw pretty deep corrections on mid-cap, small-cap software companies and many other companies. So I would say we might go back into that era, which is, you can say, from mid-2023 to mid-2024 kind of era, where stock-specific analysis will matter more than the macro headwinds or tailwinds.
Okay, thanks. Yeah, I was just interpreting the debt part of it. You said, companies that are more susceptible or to debt, they will be impacted, like banks, etc. So basically, they were probably expecting a deeper rate cut, but it won't be as deep. So that's why they're getting impacted.
Oh yeah, I would say banks. When I said because we all know how banks work, right? Even if they're impacted, they're already impacted. By the way, they are suffering, but they're all protected by the whole program where they are marking their balance sheets on, even though the bonds are at a zero. Oh, sorry, bonds have had a 30 to 40% drawdowns mark to market. They don't need to market at losses. And Fed has given them a backstop, right, where they were able to borrow from them. Now that that program is ended, and new administration may not be as open as assuming what we believe what they're saying. So yes, banks will be at risk if the rules change around whether Fed can continue act as backstop, whether they will allow some banks to fail, which was not the case for previous administration. So yes, those factors will matter. And but on the other hand, as I said, Fed rates are not really driving everything. Means bond, we discussed that bond market was already going up, like the yields were going up even before Fed. So maybe we will top out on the bond yields and we will start going down, and it will help the whole sector. So this is why we said that we have to carefully monitor whether long-term yield do from here. This may be, even though it's a big news, this may actually turn out to be the turning point for medium to longer term, now that the news is out of the way. So a lot of variables still there, which we cannot predict today. We will probably monitor over the next few weeks and months of how bond yields act. But yes, means any company which was relying on refinancing their debt for lower rates, and that is definitely very clear now that we are not going down to 2% or 3% rates very soon. We are probably going to stick around in 4% or close to 4% for much longer. So from that perspective, maybe one more parameter to watch is the high yield spreads, which we discussed a little bit during our investor day also. What if they start going up now? Because now the risk on those high yield bonds will be higher if rates are not going down fast enough. Because earlier we were in a Goldilocks situation. The growth is great, no recession, and the rates are coming down. Now we have taken out one aspect of it, of that we are not cutting four times next year. So 50 basis point is a big enough thing to make a business fail or succeed based on the projections, and especially if the spreads increase, because today the spreads are still low. So the impact of Fed rates or not cutting is not that huge, because people are able to borrow very close to the risk-free rate, even on if you're not highly rated company. So beyond the rate cuts, I would say we have to observe the high yield spreads on whether they start increasing. So bond market will be the important part to monitor on real impact to the companies.
Okay, thanks.
All right, guys. So I think my intention was to keep it short, just to have the ability to ask questions. Some of you joined late, so let me know if you have any questions. And we are recording this, so we'll make it available to everyone. So
Hey, Raman,
this is
quick
again,
question.
yes, go ahead.
So what if Trump replaces Powell and then the direction changes again?
So first of all, I think Trump has indicated that he would let Powell complete his term. But even I think if that should not change in general, because if you see today that like while Powell is still the handles the press release and so on, when we look at dot plots, it is across different Fed governors who are voting for a certain direction of where we should be. And I think that there is not much I'm expecting from politically on this side, but other than just I think they may be a little more aggressive on the unemployment, which parameter they watch closely. And they may say that we are not worried about inflation that much, and we want a lower unemployment or something. So yes, so I think that usually there is enough levers which politicians have to just guide it or even impact the individual Fed voting members. So I don't think that will change much, because the fact is that inflation definitely had stalled. So that is the main reason where most of the Fed governors will not be able to vote in the favor of continuously cutting rates. And as I said, right, means mostly it's not even Fed which is deciding. Bond market is already guiding them in that direction. So real rates are medium to longer term rates, which Trump would care about is, politically it matters is mortgage rates and so on. And those are anyway very limited control of Fed. So Fed is mostly following today in where they should, what bond market is suggesting them. So I don't see a huge change happening because of politics here. So that's very difficult. And again, means we are talking about now more like 3 to 4% range. The difference between what Fed can do by going aggressive versus they have already done pretty aggressive cut, to be frank, in last 3 meetings, like 100 basis point in 3 meetings. Was pretty aggressive. We are no longer at crazy 5% rates. And when I say crazy, this is from recent times only, right? Means even 5% was never considered high 20 years ago. So market was only worried about the pace of cuts and pace of rise. Both of them are behind us now, I believe. And we might stick around to this in this 1% range of 3 to 4% for a very long time. So that's my view on where we are. And ultimately, the long-term yields and the inflation numbers will matter now going forward. All right, so I think this was great to have all of you. We'll close this for now and look forward to having more of these discussions, I think at least critical points, just to
Hey,
make sure
Raman,
we all understand. Yeah, go ahead.
sorry, quick one. So for the NVIDIA, the puts we sold, is it a good idea to kind of keep the position, continue with the position because they are still even money, or given the turmoil or potential turmoil, maybe exit it and then enter later?
So Ritesh, I think let me put it this way. Means definitely we are always watching all of our position for all access subscribers. So we will let you know when we think is a time to change the position. But overall, let me tell you that because we're talking macro right now, means we don't think this is going to change individual stock position. And maybe we'll have this correction and all these, we usually try to enter new trades only when we think it's a great time. So that trade is still pretty much in the play. And as you said, though, that is still not losing money yet in terms of break-even point. So we would make sure that we are not, and we will keep you updated on that. If we believe that we need to either roll it or we need to close it in either direction.
Okay, thank you.
All right. So thanks everyone for taking time out on middle of the day, and this was great to have a quick discussion, and we will make this recording available. If anybody has any other questions, let's continue this in our WhatsApp channel. And to all access subscribers, I think we will keep you updated on specific trades and specific adjustments we are planning based on this new signals we are getting now with this Fed release. And as I said, there's a lot more going to happen in next 2 days as we see the markets adjust to the news, because usually smart money, like the big money, adjusts they take time to absorb, but they usually adjust within 2 days. So by Friday, we should see most of the market adjustments on yields on stocks, and we will be in a better position to guide you on how to adjust your portfolio. Thanks again for joining, and talk to you soon. Bye-bye.